Viewers at home, you are welcome to my presentation on statement of cash flows. This is the extension of my lectures on statement of cash flow, IAS 7. So I'm going to take questions from K-Plan, practice, and examination kit. So we are given a question. This question is obtained from K-Plan kit. Kingdom is a publicly listed manufacturing entity. Its draft summarized financial statements for the year ended 30 September 20x3 and 20x2 comparatives are: you are given statement of profit or loss and other comprehensive income for the year ended 30 September. You are given for 20x3 and 20x2. All figures are in thousand. The first item is revenue, 44,900, 44,000. Cost of sales, gross profit, distribution cost, administrative expenses, investment properties. We are given rental receipt, fair value changes, finance cost, profit before taxation is given. Then we are equally given income tax. Then we have profit for the year, other comprehensive income, and we equally have total comprehensive income. Statement of financial position as at 30 September, we are given 20x3 and 20x2. We have assets, which include non-current assets. We have property, plant, and equipment. Then we have investment property. Then we have current assets. Current assets, and that include inventory, 2,300 and 3,100 respectively for 20x3 and 20x2 respectively. We have trade receivables and we have bank. Then we also have total assets. This is total current assets and this is total assets. By total assets we mean the total of non-current assets and total and current assets. We have equity and liabilities. Under equity we have equity shares of $1 each. Then we have revaluation surplus. We have retained earnings. Then we have non-current liabilities, which include 12% loan notes. Then we equally have current liabilities, which include trade payables, accrued finance cost. Then we have bank, and we have current tax payables. We have total equity and liabilities. On 1st July 20x3, Kingdom acquired a new investment at a cost of $1.4 million. On this date, it also transferred one of its other investment properties, included as property, plant, and equipment, at its fair value of $1.6 million, as it became owner occupied on that date. Kingdom also has a policy of revaluing its other properties, included as property, plant, and equipment. So then we have to market values at the end of each year. Other comprehensive income and the revaluation surplus both relate to these properties. Depreciation of property, plant, and equipment during the year was $1.5 million. An item of plant with carrying amount of $2.3 million was sold for $1.8 million during September 20x3. Required: prepare a statement of cash flows for kingdom for the year ended 30 September 2023 in accordance with IAS 7 statement of cash flows using indirect method. That is the question. So you are to prepare the statement of cash flows in accordance with the provision of IAS 7 statement of cash flows using indirect method. Please subscribe to keep up with my upcoming lectures. I'll be dropping more lectures from time to time. Please subscribe and like my lectures. Solution. The name of the entity is Kingdom. You are to prepare statement of cash flows for the year ended 30 September 2023 using indirect method. Have dollar and triple zeros. Dollar and triple zero. The first thing or first heading should be operating activities. Operating activities. If you have watched my lecture on IAS 7, I've defined operating activities as the principal activities of the business. I said there are activities that arises in the normal course of business. You want to prepare statement of cash flow using indirect method. The number one thing you should start with is the profit before taxation. Profit before taxation 2,400. You are going to use that of the current year. The comparative statement of profit or loss for 20x2 is not relevant. The statement of profit or loss, the comparative figure, is not relevant. It's only the statement of financial position that you will need the comparative figure. That of 20x2 is not relevant. You only need the information in statement of profit or loss for 20x3. You are going to take the profit before taxation. Profit before taxation. Profit before taxation. Then you are going to adjust for three things. There are three things that will require adjustment in this profit. Number one, we have non-cash items. Number two, we have changes in working capital. And the third one is items that will not appear as operating activities. Items that will not appear as operating activities which have been used in statement of profit or loss before arriving at the profit before taxation. That means you go through your statement of profit or loss from the beginning. There will be number of items that will appear in the statement of profit or loss that will not fall under operating activities. Now let's check. Revenue is normal, cost of sales is normal, distribution cost is normal, administrative expenses is normal. Then we have investment properties. Investment properties, that is an investing activities. That means the rental received on investment properties will fall under investing activities. So since those information have been used before arriving at the profit before tax, then you will need to adjust them. You will need to adjust them. So when preparing the statement of cash flows under operating activities, the rental received has increased our profit before taxation. The rental received has led to increase in profit before taxation. Therefore, you are going to subtract it. The fair value changes, since it is a deficit, so it has led to reduction in the profit before taxation. So you are going to add this. You subtract the rental receipt, which has led to an increase in the profit before taxation. Then the fair value changes, which is a deficit, which has also led to the reduction in the profit before taxation, you are going to add that. Then we have finance cost. Finance costs are interest related items. This interest arises as a result of the entity raising money to finance the operation of the business. So interest could be financing activities. Since this interest has been deducted, has led to the reduction of the profit, so you are going to add it back. So that is number one. So you are starting with profit before tax. You have adjustment for I've told you that you are going to adjust for non-cash items that will not appear as operating activities, then, and the items that and the changes in working capital. I've told you that those are the three items that will require adjustment. So you are going to take the profit before taxation of 2,400. Then you are going to deduct rental receipt. You deduct the rental receipt, you add fair value changes, then you add the finance cost. Those things that have led to increase in this profit before tax will be deducted, and while those things that have led to reduction in the profit before tax will be added. So now you take the profit before tax, you deduct this, you add this, and you add this. So now let's go to the preparation of our statement of cash flows proper. So the first thing, we have operating activities. I've told you that you are starting with the profit before tax, profit before taxation, and the profit before taxation is 2,400. 2,400. Now have adjustment for. I've told you that you are going to deduct rental received on investment property. Investment properties. We have the rental received. I told you that will be deducted, which is 350. You subtract that. Then we have fair value changes. Fair value changes of 700. I've told you that because it is fair value deficit, you are going to add it. Then we also have finance cost, which is 600. So you are going to add that too, because it has led to the reduction in our profit before tax. Now let's go through the note. Those are the information that doesn't involve that are not operating activities which have been used before arriving at the profit before tax. So then you go through. I've told you that non-cash items that doesn't involve the flows of cash, I said they will be adjusted, like depreciation. Now let's go through the note. Market value at the end of each year, other comprehensive income, and the revaluation surplus both relate to these properties. We have depreciation of property, plant, and equipment during the year was 1.5 million. So depreciation does not involve the flows of cash. You have depreciation of 1.5 million. So it does not involve the flows of cash. Depreciation will have been charged as an expenses before arriving at the profit before tax. Since it has been charged, that means the profit before tax has been reduced by the amount of depreciation charged. Then, an item of plant with carrying amount of 2.3 million was sold for 1.8 million during the year. When there are disposal of an asset, the asset may be disposed at a profit, or it may be disposed at a loss. Now, when the carrying amount of the asset sold or disposed is greater than the sales proceed, that means it is disposed at a loss. But where the sales proceed exceed the carrying amount, that means it is disposed at a profit. So the carrying amount is 2.3 million and it was sold for 1.8 million. That means the asset has been sold at a loss. So you now have loss on disposal of plant. The carrying amount is 2.3 million and the proceed is 1.8 million. So 2.3 minus 1.8, the difference is 0.5 million, which is 500,000. So it was sold at a loss of 500,000. So now, after this adjustment, we have 350 minus 350 plus 700 plus 600 plus 1,500 plus 500. Then you have 2,950. 2,950. After 2,950, so this is positive. This plus 2,400 plus 2,400, then the total is 5,350. 5,350. That is the net operating cash flows before changes in working capital. After this, the next thing you are going to deal with will be changes in working capital for the period. Changes in working capital. For the period. Working capital is current assets less current liabilities. Current assets less current liabilities. So that means we are going to compare the current asset in the statement of financial position. You are going to compare the current assets as per the statement of financial position. So, as part of our current asset, you have inventory. Inventory is number one. So we have inventory. The inventory now, the closing is 2,300, while the opening is 3,100. Since if the closing is lower than the opening, that means inventory has reduced. This is a decrease in inventory. So, decrease in inventory. I've told you that decrease in inventory should be added. Decrease in inventory should be added, while increase should be subtracted. So, you are going to add a decrease in inventory. So we have decrease in inventory. Decrease in inventory, that is 3,100, which is the opening, minus the closing, which is 2,300. So 3,100 minus 2,300. Then you have the difference of 800. That is inventory. After inventory, you have receivables. Trade receivables. The closing is 3,400. While the opening is 3,000. That means there is a decrease in receivables. So we have decrease in receivables. Decrease in receivables, which is 3,400 minus 3,000. Then you have 400. Decrease should be added also, since they are part of current asset. After receivables, as part of your current asset, you have bank. Bank is cash, so cash will be excluded. After current assets, then you have current liabilities. Current liabilities. Current liabilities. We have trade payables. This is an increase. Increase in trade payables. Increase in trade payables. Increase in trade payables. We have 3,900 minus 4,200. I've told you that liability is opposite of asset. Liability is opposite of asset. Then you have difference of 300. So, meaning that increase in the asset will be minus, while decrease in asset is plus. So the opposite of it is liabilities. Increase in liabilities will be plus, while decrease in liability will be minus. Then after trade payables, as part of our current liabilities, we have accrued finance costs. Accrued finance cost. This is interest, and that will be treated as part of interest, so you exclude that. Bank, this is a bank overdraft, is also cash, so it should be excluded. Then current tax payable should be adjusted in tax, so you exclude that. Now, then you have 800 plus 400, that is 1,200, plus 300, and that will be 1,500. 1,500. 1,500 plus 1,350. Then you have, 1,500 plus 5,350. 5,350 plus 1,500. Then you have 6,850. 6,850. Then after this, you are going to deal with interest and tax. Interest and tax. That is the next thing to consider. You are going to consider your interest and tax. So, interest paid. Interest paid. Interest paid. That is the next item. Interest paid. Let's have that as working one. Interest paid. That is working one. So, I've told you that in any of your working that you should always start with the opening balance. Working one, opening balance. If you go through your current liabilities, you have accrued interest there. As part of your current liability, we have accrued interest. Accrued interest. So, accrued finance cost, which is 150. This is opening. Opening is 50, while closing is 100. I've told you that you should always start with the opening. That means you are going to have opening. You start with the opening, then opening, which is 50. That is opening accrued finance cost, which is 50. Then if you go through your statement of profit or loss, you have finance cost of 600. I've told you that you don't need the comparative figure. The one you need is that of the current period, which is 600. Now have statement of profit or loss. Statement of profit or loss, which is 600. That is the one you have there. Then you now have closing accrued finance cost, and which is given to be 100. I've told you that you should always subtract the closing balance. Opening plus whatever you are given minus the closing. 650 minus 100. 50 plus 600, that will be 650. Minus 100, that will be 550. So the interest paid is 550. 550. After the interest, you have taxes paid. Working to just the same way as to the calculation of interest. So the way you have calculated your interest is the way you are going to calculate the amount of tax paid. So working to now, working to taxes paid. Opening balance, that is of your tax liability. To get that, you are going to check your current liability section. You are going to check the current liability section of the statement of financial position. The current liability section of the statement of financial position. You have current tax payables. The closing is 500, while the opening is 1,850. You may be given deferred tax under non-current liabilities, but in this question there is nothing like that. So that means you only have taxes payable under current liabilities. So you are starting with the opening balance 1,850. I've told you that you always subtract the closing. So you have opening balance of 1,850. Opening balance of 1,850. 1,850. Then in your statement of profit or loss, you have tax expense. Income tax. Income tax of 600. You only need the one for the current year. You don't need the one in the comparative statement of financial position. I've told you that the comparative statement of financial position don't need any item there. So you are using this $600 alone. So you have tax expense, that is income tax expense, which is 600. Then you have closing balance, that is your tax liability under current liability, the one in the closing statement of financial position, and that is given to be 500. So you have this 1,050 plus 600 minus 500. Then you have 1,950. 1,950. So that is tax paid. Then you include that under operating activities. So tax paid is 1,950. So under your operating activities, we got 6,050 before. 6,050 minus 550 minus 1,950. Then you have 4,350. 350. That is net cash flows from operating activities. After operating activities, the next section or heading should be investing activities. After that, investing activities are activities that result in changes in non-current assets. Activities that result in changes in non-current assets and investment, that is investing activities. They are activities that result in changes in non-current assets and investment. I've told you that whenever you get to investing activities, you are going to check the movement in non-current assets. You check the movement in non-current assets. I've told you that there are a number of items that will make our non-current assets to change. Now, in the statement of profit or loss, we have investment properties. I've told you that investment properties is non-current asset, where you have rental receipt. This is the amount received, so that is investing activities. Fair value does not involve the flows of cash. It does not involve cash flows, so that is why we are not going to include the fair value of $700 as investing activities. So you are starting with rental receipt, investment property, rental investment property, rental receipt of $350. $350. The rental receipt is an inflows, is a cash inflows. I've told you that you check the movement in non-current assets. You check the movement in non-current assets. Our non-current assets include the property, plant, and equipment. You want to check the movement in property, plant, and equipment. That is working three. Movement in property, plant, and equipment. Don't forget, I've told you that in any of your working, you start with the opening balance. The opening balance of our property, plant, and equipment is 25,200. 25,200. You are starting with that. 25,200. There are a number of items that can make the PPE to change. Number one, we have depreciation. Where PPE is depreciated, the value of the PPE will reduce. By PPE, I mean property, plant, and equipment. That means the depreciation will bring about the reduction in the value of our property, plant, and equipment. We have depreciation of 1.5 million. Depreciation of property, plant, and equipment during the year was 1.5 million. Since depreciation will bring about reduction, so you are going to subtract the depreciation of 1.5 million from our property, plant, and equipment. So you have depreciation. 1.5 million. Apart from depreciation, PPE may be revalued. It may be revalued. So you check information about the revaluation of PPE. You check the information about the revaluation. Now you have revaluation surplus. Revaluation surplus under equity. The one in opening balance is 2.5 million while the closing is 1.2 million. That means there is a revaluation deficit. The difference between 2.5 million and 1.2 million, which is 1.3 million. Don't forget, in accordance with IAS 16, property, plant and equipment, the movement in revaluation of PPE will be incorporated in other comprehensive income. That is why if you check your other comprehensive income, you will see the difference in revaluation of 1.3 million. It's a revaluation deficit. 2.5 is now reduced to 1.2. So revaluation deficit. And that will be found under other comprehensive income. Revaluation deficit will bring about, or it will make your PPE to reduce. If you check your other comprehensive income, you have 1.3 million there. That 1.3 million is the revaluation deficit on PPE. So you are going to subtract the revaluation deficit. So you have revaluation deficit, revaluation deficit, which is the difference between the 2.5 million and 1.2 million. So the difference is 1.3 million. Revaluation deficit, I told you that it will bring about reduction. It will make the PPE to reduce. That is why we are subtracting that. So I told you that revaluation deficit is also the amount we have under other comprehensive income as 1.3 million there. So then you also check your note. There could be number of items. There could be a number of items that will affect our PPE. So apart from the depreciation and the revaluation. Now let's check the note. On 1st of July 2003, Kingdom acquired a new investment at a cost of 1.4 million. No investment have just been acquired. In fact, the investment bought too is also part of the non-current asset. On this date, it also transferred one of its other investment properties, included as property, plant and equipment, as its fair value of 1.6 million. That investment property, the fair value of the investment property is 1.6 million. You want to transfer it to property, plant and equipment. That means you want to transfer this 1.6 million to property, plant and equipment. So fair value of investment properties. So when you transfer it to PPE, that means the PPE will increase. The PPE will increase. So we have investment property of 1.6 million. 1.6 million investment property. Investment property. The PPE will increase when you transfer the 1.6 million to PPE. It is going out of investment property and it is coming into the PPE. That is, it is coming into the property, plant and equipment. So then we've considered the revaluation. Then there is a disposal of PPE. There is a disposal of property, plant and equipment. So where PPE is or are disposed, the value of the PPE will reduce. The value of the PPE will reduce. You are given depreciation of property, plant and equipment during the year was 1.5 million. An item of plant with carrying amount of 2.3 million was sold for 1.8 million. It was the carrying amount is 2.3 million. So there is a disposal of PPE. So the carrying amount of the PPE sold now, you have to remove it from it. The carrying amount of the PPE sold or disposed. So we have disposal at carrying amount. The carrying amount of the PPE disposed is 2.3 million. When you dispose PPE, that is, dispose means to sell. When you sell PPE, that means the PPE will reduce. The amount of PPE you will have will reduce. Then you also check if there are other information. We have considered the opening balance, depreciation have been considered, disposal have been considered, investment property and revaluation have equally been considered. Then the closing balance of the PPE. The closing balance of PPE is 26,700. Now, after all this adjustment, how much is your PPE? 25,200 minus 15 minus 1,300 plus 1,600 minus 2,300. Our PPE ought to be 21,700. Now, the value of the PPE at the end of the period has fell to 26,700. It has fell to 26,700. Closing balance 26,700. Since the closing balance exceeds this, that means more PPE has been bought. That is why the value of the PPE has increased. More PPE, more property, plant and equipment have been bought. More of it have been bought. Then you are going to have purchases of PPE. Purchases of PPE. Which is 5,000. So that will be included as investing activity. Purchase of PPE, and that is 5,000. 5,000. When there is purchase of PPE, more cash will leave the entity, so it will be treated as an outflow. That is working 3. Working 3 to be treated as an outflow. So then you also check if there are other non-current assets apart from PPE. Apart from PPE, you have investment properties. Investment property. So we have opening balance 5,000 and closing balance. Let me have working 4. So we have movement in investment property. The opening balance. Opening balance of investment property is given to be 5,000. 5,000. Then remember 1,600 has been transferred to PPE. Transfer to PPE. 1,600 that you have transferred, that means it will go out of investment property and it will go to PPE. So transfer to PPE 1,600. Then we also have purchase of investment property. So we have purchase of investment property. Purchase of investment properties of 1.4 million. So you were told on 1st of July 20x3, Kingdom acquired a new investment at a cost of 1.4 million. At a cost of 1.4 million. So that means there is a purchase of investment property. When there are purchase of investment property, so you have purchase of 1.4 million. That means the investment property will increase because there are purchase. Then you also have fair value. The fair value changes on investment property, which is 700. Fair value changes. This is a fair value deficit. That is why you have it in jacket. It is in braces, in bracket, because it is a deficit. So that means the investment property will reduce. Then you compare this with the closing balance. So 5,000 minus 1,600 plus 1,400 minus 700. Then you have 4,100. Closing balance. Closing balance of investment property. The closing balance is equally given to be 4,100. 4,100. So now the difference will be nil. So you only consider the purchase of investment property, and which is given to be 1,400. Purchase will result in an outflows of cash. So put it in braces. That is investment property. Then, as part of our investing activities, you have the proceeds from the disposal of property of plant. The plant which was sold, it was sold for 1.8 million. That means it was sold at a profit. I mean the proceed, the actual amount it was sold is given to be 1.8 million. And that will also be reported as an investing activity. So you have sales of plant. Sales of plant. It is the proceed that we need to be considered here, which is 1.8 million. When you sell plant, then you receive more cash. When you sell plant, more cash will be received. So we've considered. Then you cast. You cast that. So 350 minus 5,000 minus 1,400 plus 1,800. Then you have 4,250. 4,250. That 4,250 represents net cash flows from investing activities. Net cash flows from investing activities. That is 4,250. Outflow negative 4,250. The payment exceed the receipt, 4,250. After that, the next heading will be financing activities. Financing activities. I've told you that there are activities that result in changes in composition of equity and borrowings. They result in changes in the composition of equity and borrowings. That is, whenever you get to financing activities, you check the movement in equity. You check the movement in equity. So the equity, you go to equity section of the statement of financial position. Then the equity section of the statement of financial position. Then under equity, you have equity share. Equity shares of $1 each, 17,200 in the closing and 15,000. There is no share premium. So since there are no share premium, then there are no additional information, no footnote, no further information about that equity. That means, but if you compare the closing one, it exceeds the opening one. Why would this exceed this? It is because more shares have been issued. That means issue of shares will be the difference between 17,200 and 15,000, which will be 2,200. So that means there will be an issue of shares of 2,200. Issue of shares. So issue of shares. Issue of shares. 17,200 minus 15,000. Then there is a difference of 2,200. When more shares are issued, more cash will come into the entity. There will be more cash. So it is an inflow. Then after issue of shares, aside the issue of shares, then we are still on equity. Revaluation surplus, that has been considered under the PPE. Then we have retained earnings. You will need to check the movement in retained earnings. The closing is 7,700 while the opening is 8,700. So you check the movement in retained earnings in order to know if any amount has been paid as dividend. Working for. So movement in retained earnings. I've told you that you should start with the opening balance. Opening balance in your retained earnings. The opening balance is given to be opening balance is 8,700. 8,700, that is our opening balance. 8,700 opening balance. 8,700. You go through your statement of profit or loss. Statement of profit or loss and other comprehensive income. You have profit for the year. Profit for the year. Profit for the year. And that is given to be 1,800. Then you now have the closing balance. Closing balance, that is your retained earnings. Retained earnings. The closing balance of retained earnings is given to be 7,700. 7,700. you have the closing balance of 7,700. 7,700. We have 8,700 plus 1,800 minus 7,700. Then you have 2,800. That 2,800 represents the amount paid as dividend. That is dividend paid. Dividend paid. Dividend paid. That is working for. That is 2,800. That will result in an outflows of cash. That is dividend paid. So then you also check. If you look at loan notes, you check your non-current liabilities. You have 12% loan notes, 5,000, 5,000 in both opening and closing. That means the loan notes remain constant. Since the loan notes is constant, that means no repayment of loan notes. There has been no repayment of loan notes, and there is no issue of further loan notes. So after all this adjustment, you have 2,200 minus 2,800. Then you have 600 as a difference. That is net cash flows from financing activities, and that is 600 outflows. 600 outflows. Then you take your operating activities. Our operating activity is 4,350. 4,350. Then our investing activities is negative 4,250 minus 4,250, and our financing activities is 600 negative minus 600. Then you have minus 500, and that minus 500 represents the net cash change. Net cash change. After the net cash change, then you have cash or cash equivalent at the beginning of the period. At the beginning. You check your current assets. Check your current asset. Under current asset, you have bank. The opening balance is 300 and the closing is nil. A bank of 300. 300. That is the opening balance. 300. Sorry, this is negative 500 minus 500. So minus 500 plus 300, it will be minus 200. Minus 200. And that minus 200 represents cash or cash equivalent at the end of the period. Cash or cash equivalent at the end of the period. Please don't forget to like and subscribe to my YouTube channel to keep up with my upcoming lectures. Thanks.